natural state for an economy, a capitalist economy like the US, is to grow. It could grow slow, it could grow fast, but it grows. Now, about 10% of the years since World War II, we've had a recession. What causes a recession? Usually, it's an exogenous shock that comes across and changes everything. People stop doing economic activity, they stop buying things, and the economy contracts. I've referred to this as, the economy getting murdered. The big question right now is, are these tariffs murdering the economy? And we kind of go back and forth on this idea that they're murdering the economy. We being the bigger picture of everybody, right? That they are, they aren't. If they stick around, they will. If he gives a pause, they won't. And that's going to be the big question. I had been arguing that I've been kind of giving an answer that I don't like, but it's the best one I could come up with, that I was 50-50 on a recession, but within 90 days, I'll either be at 80% or 20%. And right now, I think I'm moving more towards the 20%, that we're not going to have that recession. We're not going to have that contraction in the economy. But what we are going to have, what I'm worried about, is higher prices and higher inflation. And that's going to matter, because as I read Wall Street and as I read everybody is, okay, inflation's dead. Let's spend all this time talking about employment. Let's talk about about what the economy's doing. Let's talk about all these other things and whether or not they're going to get the Fed to cut rates. And the answer is none of that matters if we have price increases. And the Fed is not going to move at all. And interest rates are going to stay up if we have that inflation. It depends, but I think at a minimum, it's a one-time price shock is what you're going to get out of it. And then it depends on what its impact on the economy is going to be. So the overlay I'm using on this is 2022. In the first quarter of 2022, the economy contracted. Actually, what we learned in 2022 was we actually had negative GDP in the second quarter too, which a year later was revised to slightly positive. But for most of 22, we thought the first and second quarters were consecutive negative quarters. Big discussion about a technical recession. What was the Fed doing during that period? They were raising rates 75 basis points a meeting, because the March to 9% inflation, even though we were saying it was transitory, it was all because of the supply, it would come back down, didn't stop the Fed from raising rates. I think the same thing's going to happen now. Maybe it is one time, maybe it is a step function higher and then it levels off. You're right, the Fed's not going to cut rates at all. And as a matter of fact, I think the market is getting that, because the Fed fund futures are saying actually less than a 10% chance the Fed's going to raise rates in June, about a 25% chance they're going to raise rates in July at their July meeting, and their September 17th meeting went under 50% on Friday. So now the market is pricing in the next rate cut October 29th. And that one is only in the mid 50s anyway. So that one could disappear too. So we're not far away from saying, you're right, this is bad. Don't worry, in 9 months, the Fed will cut rates one time. Well, the argument here is that they're not going to cut rates because it's about prices. And prices is what it's about. Now, to the idea that it's a one-time step function, we increase tariffs, prices go up, the economy doesn't have a recession, everything's okay. Trump will do it again. The only time he's going to stop increasing tariffs is if there's a bad reaction to it. So we would have to argue that there was such a bad reaction that we would call him off. And if that bad reaction is a weakening economy, higher unemployment, well, that ain't showing up yet right now. And it would also have to come with no price increase. So I think that a lot of people are not in this idea that it is, what I'm trying to argue here is the most important thing is prices being inflation. And the reason they're going up matters more than whether or not the economy is having a recession and unemployment's going up, or retail sales are weakening. By the way, none of that's really happening right now, but the fear is it will. Then those are of secondary importance, but the way it's being described is the other way around, is that the impact on the economy matters more, and that's what the Fed should be responding to. Just listen to all the questions at the FOMC meeting, what Powell took during the presser. Right. Every question was, why aren't you cutting rates? The economy's going to go bad. And he was trying to say, but we're worried about prices. Who cares about prices? Cut rates, the economy's going to go bad. And Powell was trying to say, I care about prices. And I think he's right to care about prices. And that's why I think I'm taking the under on all these rate cuts. If you go back to 22, the biggest issue was inflation. May of 22, President Biden famously had his one and only meeting with Jay Powell, where he literally pointed to him sitting on the couch and said, America, that's the guy who's going to fix the inflation problem. By 24, the inflation rate went from 9% to 3%. And when you asked everybody in the polls, what is the single biggest economic issue facing the country? They said inflation. And the administration kept trying to tell you, yeah, but it was 9 and went to 3. It's no longer a problem. Now, why did we keep saying inflation was a problem? Because we completely underestimate how devastating inflation is, especially to the bottom half of income that doesn't own a home, doesn't own a portfolio, is reliant on their wages, their raise to be greater than the inflation rate. Because you and me and everybody listening to this, if inflation rate goes up, we have the ability to pay those higher prices. They don't. They have to make choices that nobody wants to have to make. You have to take something else out of the grocery basket if you want to put this into the grocery basket because we only have so much money. And so that's really why inflation is such a problem. Now, if we get a one-time step function up in inflation and the Fed's reaction is, well, unemployment might be bad, so we'll cut rates. We'll make it easy for people to pay that higher price. You're subsidizing that higher inflation. Now, let me give you another statistic. National Association of Retail came out and said that 50% of the retail sales in the country is now done by the top 10% of income. And that's the most concentrated it's ever been. Half the stuff that's bought at stores in the United States is done by the top 10% of income, the most concentrated it's ever been. Let's cut rates and make it easy for them to hold those prices up. And then we have to explain to the bottom half of 50% why they can't afford anything. That's the mistake you make by cutting rates. Let's subsidize these higher prices for rich people, but so then we put poor people behind the 8 ball. Paul was right in 22 when he gave his Where There Will Be Pain speech in August of 22, where he said, look, we can't let prices go up. And if you rich people have to take pain, do your patriotic duty and take it, because we can't subsidize these higher prices. That's why I don't think they could be looking past even a one-time step function, because the public will be so irate over what was happening to them. That's the bottom half of income. And so that's why you don't want to go there in the first place. I think what the Trump administration is saying, as Trump says, is, look, there is no inflation. There is no reason for rates to be at these levels. You can cut rates and bring them down, is what they're doing. Now, at the other time, what Trump has been saying is there won't be any retail impact on tariffs, because he's been screaming that the Chinese will eat the tariffs. He's screamed at Walmart. He is trying to bring back jobs into the United States. He is trying to bring back income to the United States. And I think it's the right thing, what he's trying to do. I don't know if this is the right prescription. In other words, the amount of debt, the deficit, what the trade deficit has done to us in globalization. Look, we all benefited from globalization. What we have learned is there was a price to globalization. It was not a cost-free win-win situation. And the price of globalization was gutting a lot of manufacturing, heavy industry types of jobs. Now, why are these jobs important? 65% of the American public does not have a college degree. If you're looking to make a decent income without a college degree, it's usually working with your hands. It's manufacturing, it's construction, it's heavy industry. And those are a lot of the jobs that we gutted and sent overseas. Now, other people are going to be screaming at me, no, that was technology that pushed those jobs overseas. Or that was technology that automated away a lot of those jobs. And that might be correct. That technology was about to automate those jobs away. Just look at any image of an auto assembly line in Detroit where it's all a bunch of robot arms putting together the cars. It's no longer employees putting together the cars. That's true. But I would also argue that China entering the WTO in 2000 accelerated that process. So there was a natural attrition coming that got accelerated because of China. And so it came faster than everybody thought it was or naturally would have. And that's where the price was. So Trump is right. Look, this group or segment of the population paid a price. We need to do something to help this segment of the population. And no, it's not worker wage training or give them subsidies. We've tried all that. It doesn't work. He wants to, this gets back to what I thought was the winning formula for his 2016 campaign, right? When Barack Obama famously said, was he going to do a wave of wand and make those jobs come back? And a lot of people that heard Obama say that and said, look, what Trump is at least trying, you've given up on even trying. I will go with the guy who's at least going to try. And so that's why I said what he's identified is correct, that there's a problem, especially among the working class here, because we've gutted their jobs. Is the solution that he is proposing the right solution? And that leads off with tariffs and a lot of other things. That we could argue maybe is incorrect. But what is the proper answer? Is the answer, because this is where, when I read the mainstream press and they say, look, the tariffs are wrong, the tariffs are going to destroy everything. Look, you might be right. But what you're implying is stop. Go back to $7 trillion deficits or budgets, $2 trillion deficits. Just keep borrowing. Just go back to the status quo that we used to have and everything will be okay. We can't go back that way. So if you don't like this radical policy of all these tariffs and jerking around with tariffs and stuff, then give me another radical policy, because we're not going backwards. We're only going forwards. And maybe we took the left-hand turn on the road and you're saying we should take the right-hand turn on the road or vice versa. But, we're not putting the car in reverse and we're not going back the other way. There's two sources. They're kind of the same thing. One of them is called Trueflation, and the other one's called Price Stats. Trueflation and Price Stats are these big data services that basically measure millions of web prices every day. And then they kind of aggregate all of these prices into like a daily estimate of CPI. And they can break them down by various categories as well, too. The caveat I will give you with this data is it tends to be goods-based, right? It's hard for me to go online and find the price for a plumber to fix my toilet or for a doctor, how much he's going to charge me. That's usually negotiated face-to-face. And so goods inflation tends to be lower. So what you want to look at with these measures is the rate of change, not necessarily the levels, because the levels are much lower. And the rate of change has been going up since about May 1st. I'll start with Price Stats. Price Stats is broken down the pricing of products by origin. And the prices of products that originate out of China going straight up since May 1st. And Trueflation does more of an aggregate level. And since May 1st, they have said that CPI has increased by 0.7%. That's a big increase, in less than a month. The last thing I'll mention is what the Price Stats data is also showing is some evidence that all prices are going up. So what the Fed would refer to this as, and I think this is why what we're waiting for gets to interest rates, is what they refer to as unanchored inflation. If you give me a reason to raise a price, do I use that excuse to raise every price? And there is some evidence that might be happening. Look, we've got these tariffs, so we got to raise prices. Yeah, but you're raising prices on everything is what you're doing. You're trying to get away with raising as many prices as you can, which we refer to as unanchored inflation. And that's what really worries the central bank, is that there's this inflation mindset that's setting in. Now, I'm not saying we have it, but there is some indications that might be unfolding in the economy right now. And that's what I think we're starting to see in interest rates and in bond yields going up over 5%. And what we're seeing is a combination of two things, that we have higher levels of inflation and we've also started to see huge deficits. When you have higher levels of inflation, the bond market, because it's a fixed income security, is going to demand risk premiums. We call those real rates, right?
Yep.
I want my yield. If I think inflation is going to go up, I want interest rates or yields on my bonds to be above the inflation rate to compensate me for taking that risk. So we're seeing higher risk yields. If you want to go wonky on it, they call it term premium, and that the term premium is starting to expand on interest rates, and that's pushing up yields. Now, the other thing that is pushing up yields is also higher borrowing costs as well, too, bigger deficits.